Yeah. Am I audible? Mm. Am I audible? Good afternoon. Mm. Am I audible now? Am I audible? Mm. Yeah. Yeah. Very good afternoon. Today we are discussing about black to Indian financial markets. So under this we have capital markets, money markets, foreign exchange and derivative markets, commodity markets. These are four units are there in the black two. So in the Indian financial markets. Now, what is capital market? Let's see that introduction about this financial markets. So it refers to platform and system through which various financial instruments are traded, providing a mechanism for the mobilization of allocation funds in the economy. So, in the Indian, we are going to mobilizing that funds and mobilizing the funds and allocating the funds into the economy. So here the capital markets, money markets, or foreign exchange, derivative markets, or commodities markets are uh, you know there in the financial markets. Especially these are the financial instruments, so which are traded in the traded and providing the mechanism. So in the financial markets. So now let's see that what is the capital market. So capital market is in India is a critical components of the financial system. So serving as a conduct for the long-term funds. So capital markets, they're raising the funds from the public for long-term purpose. So in the financial system, it facilitates the allocation of resources by channeling savings into productive investments, and contributing significantly to the economic growth. So if you fund, if you now raising the funds from the public, they are going to utilize the resources and channeling the resources into productive investment. So they're significantly, useful to the or else helping to the Indian economy for the growth of the nation. And here the key features are there in the capital market. So let's see that the long-term financing, liquidity, transparency, diverse instruments, and also wide participation. These are the key features in the Indian market, Indian capital markets. So long-term financing. So deals with the long-term financial instruments with the maturities exceeding 1 year. So long-term investments, exceeding with interest and dedicated adults, no, fixed interest will be there in the time that is going to be get the matures within the 1 year. So liquidity, it offers a platform to buy and sell securities, ensuring liquidity for investors. So those who are their investors, there is to going to be liquidity. It's going to be liquidity. So here there is buying and selling options are there, and buying and selling options about the securities, and they're also liquidating their investments. That means their funds transparency. So it's regulated by the SEBI. So ensuring fair practices and investor protection. So any customer or any funder, the investors, they used to see about the how that SEBI is going to be regulating towards their funds and also ensuring that whether they are not using uh, you know transparency practices or not. So that is important key features in the Indian capital market. So that is there. So that is there in the capital market and the diverse instruments. So it includes equity, debt, mutual funds, and also derivatives. So diverse investments. We can also diversify our funds into different portfolios like equity, debt, mutual funds, and also derivatives. So we can diversify our instruments, maybe financial funds, into different portfolios and wide participation. Here, that how many individual investors, institutional investors, and foreign investors, all are the wide range of participations are there in terms of in terms of financial institutions. Now, these are the components of capital market. So, components, the primary market is the new issue market. The purpose is that to facilitate the issuance of new securities by companies to raise capital. So, it facilitates the issuance of new securities. So, companies to raise capital, like key methods of issuance and initial public IPOs, FOs, follow-up public offerings, and also private placements, right issues. So all are the methods to issuance of the securities, so by the companies to raise the capital. So now today also, like Jepto company also coming to these IPOs. So earlier we used to see that we are evidence for that PATM or LIC. So companies are going to raising the funds from the public as a capital. So in the new issue market, so like initial public offerings and also follow-up FPO. FPO also follow-up public offerings also is there in the private placements, right issuances. It helps the companies to fund expansion, innovation, and debt repayment. So here then if you're going to raising the funds from the public, that helps to companies to fund expansion. The companies may expand their business operations and they're also working on, they're also providing, they're also looking about the innovation and also debt repayment. And the secondary market, here the secondary stock market is that the purpose is to provide a platform for trading and existing securities. So like we know that BSE and NSE, Bombay Stock Exchange and now National Stock Exchange. So they're the key stock exchange in India. So Bombay Stock Exchange is the India's ACS oldest stock exchange. So in the India, in the Asia's continent is one of the oldest stock exchange. And National Stock Exchange. It is known for its advanced technology and derivatives are trading. So it's advanced technology they're using that National Stock Exchange that is there in Delhi. And also role, it offers a liquidity and marketability for securities. So what is the role of the secondary market? Nothing but to offer the liquidity and marketability about their products and the services that is going to be exchanging between the parties in the market. Now, types of instruments in the capital markets. Let's see what are the types of capital markets. So here the equity instruments, debt instruments, hybrid instruments. What is the equity instruments? Here the shares and shares are the representing as a ownership in a company. So you're going to be going purchasing any shares. You're going to be getting the equal rights. That is equity. So that is known as equity instruments. Debt instruments. So bonds and debentures are borrowing for funds. So if you are going to, for example, if you're going to using that bars, you know, um, bonds or say debentures, they're borrowing funds from the public. So for that reason, they're using the debt instruments from the public to the public. So borrowers means the bankers or companies they issue the bonds and debentures against their say their shares. And hybrid instruments. So hybrid instruments convertible debentures and also preference shares. So convertible into maybe preference shares, maybe some other possibilities. So convertible debentures and preference shares. Now, who are the participants in the capital market? So let's see that who are going to participating in the capital market. Let's see the retail investors. So retailers means individually they are trading or investing. Individual persons, individual persons. That's very different. And institutional investors. So mutual funds, insurance companies, and pension funds. So these are the comes under the institutional investors. So they all coming as institutional, like SBI mutual funds, like ICICI mutual funds, and some other insurance companies also participating in the capital market. They also purchasing and the shares, and foreign investors, foreign institutional investors, FIAs, and foreign portfolio investors also is there, FEIs. So they are also participating from the different countries in the globe. So whenever you are there, wherever you are there, you may also participate, and you can also purchase that shares or some securities. Market intermediaries, so stockbrokers, so depository participants, and investment bankers. So these people also participates in the capital market. So so initially four types of persons. So retailers, retail investors, they're individually they're coming and investing or purchasing. Institutional wise, like SBI, ICICI, HDFC, like that, institutional wise, banking institutions wise, they're coming and purchasing. The same way, foreign investors also, they're coming from different portfolio, different um, um, and the market intermediaries, so stockbrokers, depository participants, and investment bankers. So all are coming from no, take that participants in the capital market and the regulatory framework. Securities and Exchange Board of India, SEBI. So Sales and Exchange Board of India, SEBI, ensures fair practices, transparency, and investor protection. So SEBI is going to be there to control, monitor, and also providing proper services to the investors. There and also to they're also focusing on their protection and the transparency of the business transactions, and they're also monitoring the market intermediaries and also prevents the inside trading. So if any discrepancies, any kind of problems are there, they are also involving. They're also taking this kind of issues. And the Reserve Bank of India, RBI, they're regulating the certain capital flows and overseas monetary policy. So Reserve Bank of India also is going to be there. They're also regulating like SEBI and RBI also both are the role of capital market in Indian development. So, who are the role participating? What is the role of this capital market in the Indian development? So, let's see. They're also mobilizing the savings or funds from the public, and they're also allocating the resources. They're also helping to the growth of economy, and also they're also focusing on market efficiency. So, mobilizing the savings means encouraging savings to be invested in productive ventures. So, this capital market is going to be focusing and mobilizing the savings from the public sides. And also resource allocations, they're also allocating direct funds towards efficient sectors and business and economic growth. So it provides a long-term funding for in infrastructure and industrial projects. Mhm. And also market efficiency. So market efficiency, how that market is going to efficiently working, but and recent trends in the Indian capital market. Increased foreign portfolio investment participation. So liberalized policies for uh, foreign investors. So people are increased from the foreign because of foreign public partnership, no, you know, funds are going to be coming. So they're participating very easily because of these policies, because of liberalized policies. Digitalization, introduction of online trading platforms and mobile apps. So there's a digitalizing about this particular problem. Such and also growth of startups. So more IPOs, institutional, initial public offerings from startups and technology-driven companies. They are also listing in the companies in the by and following the SEBI rules and regulations are listed in the companies. Sustainability. They're also focusing on rising interest in green bonds, means especially it's new kind of bonds and environmental, social, and governance instruments. They're also looking about this. And you can also observe these recent trends in the Indian capital market. Now see that the money market. What is the money market and what is the importance of this money market? So capital market is a different and the one money market is one of the kind of different. So the money market is a segment of financial market where short term short term instruments with high liquidity and maturities of up to 1 year are traded. So the money markets are going to be there, the segment of the financial markets. And also it's a crucial part of the financial system that enabling business, governments, and financial institutions to manage their short-term funding and liquidity needs. So it is a crucial part of the financial system. So money market, working on the governments and financial institutions to manage their short-term funding and liquidity needs. What is required to the companies for the long term and short term. So that is money market. Now, what are the key features of the money market? Let's see that features of the key money market. We have short-term instruments, liquidity, low risk, high risk, and unregulated segment are there. So what is the short-term instruments? Here it deals with the primarily in instruments with the maturities less than 1 year. If the short term is in before within the 1 year or less than the 1 year, that is going to be that is going to be there for the others deals with financial instruments and liquidity. So instruments are highly liquid, and it can be easily converted into cash. So in this money market, that is going to be very easy because if you're going to investing, that is convertible, very easy to convert into cash. Hmm? Uh, so um, low risk also is there. Low risk nothing but due to the short maturities, the risk of default is minimal. So there is a minimal risk is there in the money market. So after investing, they used to look about this short term and high value. So there is a high value of um, a large volumes of transactions will be there. So daily there is a high volume of um, yeah, transactions will be there. So it handles the large volume of transactions in a daily. And also unregulated market is there. Some parts of the money market are less regulated and compared to the other financial markets. So in the money market, we are going to see some part of money market as a less unregulated uh, the financial markets. Mhm. Now, what are the functions of the money market? So here, the functions of the money market in a liquidity management, it facilitates the money monetary policy and promotes savings and investments and efficient allocation of funds. So there is a liquidity of the management is there. So it helps the institutions to manage their short-term cash requirements. So how that is going to be liquidating in the market? and it facilitates the monetary policy. Central banks, maybe national bank and commercial banks, are use money markets to implement a monetary policy. So it feels the monetary policy means they're providing, they're linking with the money market, and they're promoting the savings and investments. And it offers a safe avenue for shorter investments. So they're offering the safe avenue for short-term investments and efficient allocation of funds, channels ideal funds into productive uses. So efficient allocation of funds are going to be there in the money market. So they're also channelizing the ideal funds into different productive uses. And the participants in the money market, who are the participants in the market? Like central bank, commercial banks, NBFCs, corporations, mutual funds, and the government. All are the participants in the money market. So central bank are regulating the liquidity and controls monetary policy. And commercial banks also, they are major participants providing borrowing and short-term funds. So for the short-term, purpose, the commercial banks are going to be providing certain borrowing, and also they are also major participants in this. And NBFCs, so non-banking finance corporations, they engage in borrowing and lending. So there also, because other than banks, the NBFCs are going to be participating in this money market, and also corporations. So the corporate companies, they raise the short-term funds for working capital requirements. So they're also raising funds for different work portfolios. Mutual funds, so invest in money market instruments to provide liquidity. So investments is going to be there in the money market, and that instruments to be provided liquidity. And government, that government involvement up to the fiscal needs. That means fiscal means financial um, issues that what which are going to be there. The issues treasury bills to manage fiscal needs. And instruments of the money market. What are the instruments? Now T-bills, treasury bills. So treasury bills maturity gets up to 90, minimum 91 days, 81 80 days, and 364 days. And sold at any discount and redeemed at face value. So what are the price values going to be there? There are also discounted and remunerated by pay face value. That means, if they're going to fix certain rate of interest, maybe 10%, 12%, that is going to be redeemed at the time of calculating the bills. So that is issued by the government to manage the short-term liquidity. And commercial papers. So commercial papers are CPs, known as unsecured short-term debt instruments issued by corporations. So here the maturity range from 7 days to 1 year, and they're only using using to meet the working capital instruments. So that is commercial paper. So commercial nothing but simply that is unsecured short-term debt instruments issued by the corporations. And certificate of deposits, so issued by banks and financial institutions. So CPs are going to be, CDs are going to be, uh, using, and they're also getting the maturity range from 3 months to 1 year tenure. And also they're offering fixed interest rates, maybe 12%, 10%, 30%, something. They agree that, but agree that both parties they come into the uh, this agreement, or else they can pay that rate of interest. Call money and notice money. So call money is a short-term loans with a maturity of 1 day. So 1 day they're going to closing, that is known as call money. So notice money. So loans with a maturity of 2 to 14 days, they are going to utilizing their funds for this session. So they're also repurchasing the agreement repos. So agreements where securities are sold with a commitment, uh, commitment to repurchase them at a later date. And so they use it for short-term borrowing by financial institutions. So these T-bills, so these repos are going to be working, uh, you know, working for short-term borrowings for the financial institutions and the bankers' acceptances. So it a short-term debt instrument issued by company and agreement guaranteed by a bank. So if we require, then we can go say, if an emergency case, then that must be solved in the now regulator of the monetary money market. So who are good regulating this money market in India? So RBI is also regulating. RBI regulating and they're regulating and monitors the money market because all financial matters comes under the this RBI. So all money market like NBFCs, foreign banks or commercial banks, which banking transactions come all together comes under the money market. They are also controlling, monitoring the money market. And so they're also using the tools like repo rate, reverse repo rate, reverse repo rate, and to control the liquidity. So they're using a different kind of uh, issues to the existing persons. So the regulated money market funds are going to be important factor. Now, importance. What is the importance of money market? So, money. Let's see. When you see closely, it is going to facilitating the economic subsidy. Economic subsidy. So, once economic subsidy is then we need to bring any kind of and efficient monetary policy transactions. So, transmission. So, this efficient monetary policy transmission helps the central banks to implement policy changes effectively. How these monetary policy transmission would be helping them to this in the money market. So that is important because that is going to be changing the policy effectively, and it provides the funding for short-term needs, supports business, governments, and financial institutions. The providing the fund for short-term needs and promotes savings and investments. It offers a safe and liquid investments opportunities. So recent trends in the money market. So increase in digitalization, the uses of electronic trading and the platforms. So um, recently the digitalization was there. That was too much, or else maybe high volume of a business was going to be there by using digitalization. So rising role of NBFCs. So greater participation in short-term borrowing. NBFCs also non-banking financial corporations also involving in the business operations and growth in the commercial banks. So so increasing preference by corporate to meet certain funding loans. So and shift in the policy rates. So frequent changes by central banks to manage inflation and liquidity. So shift is going to be there. That's going to be possible in the policy rates. Now foreign exchange and derivatives markets. So let's see. another concept that is the foreign exchange and derivatives market. So here, foreign exchange, forex market, the forex markets, and derivatives markets, they play a crucial role in the global financial system. They facilitating the international trade, investment, and also risk management in this derivatives market, foreign exchange and derivatives market. The foreign exchange market, forex or FX market, is a global marketplace where currencies are bought, sold, and exchanged at the current determined prices. It is one of the largest and most liquid financial markets in the world. It is operating 24 hours a day, 5 days a week. um, about this foreign exchange market. So they're also focusing on also this is operating in the foreign exchange. So 24 hours and 5 days a week in the world is one of the largest and most liquid financial markets. The key features. So global decentralized market. Global is a decentralized market. The forex market is a decentralized, meaning it has no central physical locations. So 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 this is decentralized market. So and because the forex market is decentralized, the meaning is in a, no centralized physical locations are there in this market, and currency as a primary asset. So currency also, um, one of the market deals with the trading of currencies pairs like a EUR, USD, that use nothing but it is a fiber. Uh, Used is a cable, and JPY is a grabber. So there is a currencies, how they are dealing with the currencies. So now see the participants in this forex market. So central banks, commercial banks, and financial institutions, corporations, retail traders, retail traders, and also speculators. So all of the participants in the foreign exchange forex market. So central banks, it influences the currency values through monetary policy and interventions. So central banks are playing influence the currency values through the monetary policy and interventions. So central banks and financial institutions, they facilitates bulk currency transactions. So they are going to working on bulk um, bulk currency transactions, and the corporations, they are going to engage in foreign exchange forex for international trade.